World oil prices seem like they're on an endless roller coaster, shooting up, plunging down, shooting up again. And when oil prices rise or fall, Canadians feel it. Oil is one of the most important commodities in the world. Its price can cause major economic repercussions. So, what's behind this worldwide roller coaster? Why do prices in Canada ride that same roller coaster? And what can we do about it? Here's a recent painful example. In a matter of a few short weeks in early 2022, the world oil price rose 65%. It hit $130 US per barrel. That jump was the biggest single factor behind the surge in inflation around the world. In Canada, inflation peaked at 8% by June that same year. Many things were happening in the world. COVID lockdowns had just ended. The world economy was opening up again. And Russia invaded Ukraine, a country that, by the way, does not produce oil. But how do all those things explain a price spike this drastic and this damaging? Let's dive into how world oil prices are actually determined, and what we find will surprise you. I'm Jim Stanford. I'm the economist and director of the Center for Future Work, the sponsor of False Profits. When people hear market, they typically assume it's all about the laws of supply and demand. If demand is greater than supply, the price goes up. On the other hand, if there's too much supply, the price goes down. In theory, an efficient market should set a price that equalizes supply and demand, and that price should accurately reflect the cost of producing that commodity. At least that's the theory. In the real world, however, most markets operate very differently from the textbooks. And the world oil market is one of the strangest. The world price of oil is not set in a gigantic market where people meet to buy and sell actual physical oil. Believe it or not, the oil price is set in a financial market where people buy and sell paper. Not literal paper, of course, but financial contracts. It's called the oil futures market. It operates on computers around the world, not at oil fields or shipping terminals. And most of the people who participate in that market have no interest in either producing oil or using it. They're interested only in buying and selling those paper contracts and trying to make money in the process. That's called speculation. Buy low, sell high. Or, if you use the right derivative strategy, buy high and sell low. As long as the price is moving, speculators can find a way to make money. The only thing speculators can't stand is stability. After all, a roller coaster is no fun if it's not moving. Speculators feel the same way about futures markets. Now, a futures contract is a piece of paper that obligates its holder to purchase a given quantity of a certain type of oil at a certain location on a certain date. But here's the problem. There are far more futures contracts being bought and sold in any given month than there is oil produced in the entire world. The vast majority of futures contracts are never exercised. They are canceled through counteracting trades that occur before the date for accepting the oil arrives. Just the two biggest oil futures markets, for West Texas Intermediate in North America and for Brent crude in Europe, they trade paper contracts worth 500 billion barrels of oil per year. That's 13 times more than the actual amount of physical oil produced everywhere. And only about 1% of the participants in futures markets have any intention of ever taking delivery of a single barrel of oil. Crude oil futures trading is worth $25 trillion US every year. That's $100 billion every trading day. Because of this vast amount of money, not oil, money, sloshing around the markets, the price of a futures contract can fluctuate dramatically anytime there's a change in the expectations or hopes or fears of the speculators trading all that paper. The resulting price changes are far bigger than justified by actual changes in supply, demand, or production costs, the things that are supposed to drive efficient markets. That's exactly what happened in February 2022. The invasion of Ukraine sparked fears of a wider global conflict. Ukraine doesn't produce oil, but Russia does, and regardless of any actual shocks to real oil supply, traders recognized this war was a good trading opportunity. Thinking the price might rise, traders jumped in. The resulting demand for paper, not oil, drove the price higher, and that sparked more buyers and still higher prices. The same self-fulfilling mass psychology can be seen in other speculative markets, like stock markets, real estate, foreign exchange, or even crypto. The problem with this kind of speculation in oil futures markets is it directly affects the prices we pay for the real energy we use in the real world. As it turned out, the invasion of Ukraine had no impact on world oil supply at all. Real supply continued growing throughout 2022 and since. Once this became clear, the futures price came crashing back down. By the end of 2022, it was back to $80 a barrel, right where it was before the invasion of Ukraine happened. But by then, the damage was done. Inflation took off around the world, consumers struggled with their energy bills, and then central banks hammered us with high interest rates. This pointless roller coaster in paper markets caused destruction and pain in the real economy, including right here in Canada. The whole roller coaster can go the other way too, but it still causes huge economic damage even on the way down. For example, when COVID hit in spring 2020, futures traders hit the sell button. They knew world oil demand would fall due to lockdowns, so they panicked and ran for the exits. Get this, the price of oil at the worst moment actually fell below zero. In April 2020, oil cost minus $40 a barrel. You actually had to pay someone to take physical oil off your hands. Now that was very unusual and reflected temporary problems in oil storage, which amplified the instability that occurs anytime futures contracts have to be settled. But there was no rational reason for oil prices to fall that dramatically. Yes, world oil demand fell in 2020, but only by about 9%. And while those super low prices seemed to offer temporary savings for consumers, they didn't last. Sooner rather than later, oil prices shot back up the roller coaster. And that gave an early and avoidable boost to inflation, just as the COVID lockdowns were ending. For Canadians, here's the weirdest part of all. We ride that same global roller coaster, even though we produce more than enough energy for ourselves right here at home. Canada produces far more oil than it uses. 80% of our oil is exported, mostly to the US. But our energy policies say the oil and gas companies have the right to charge us those same world prices, even on energy produced, processed, and consumed right here in Canada. So the latest conflict in some far-off part of the world, causing the latest havoc on paper futures markets, translates into higher bills right here at home. In fact, when futures prices spike, we usually see it in higher gasoline prices in just a day or two, even though the gasoline in that pump was produced and refined weeks or months earlier. And, by the way, prices are always much slower to come down whenever futures markets cool off. Up like a rocket, down like a feather. That's how oil prices work, it seems. So, in early 2022, consumer prices for oil and gas shot up 50%, thanks to a paper panic caused by a conflict on the other side of the world, with no relationship whatsoever to Canadian oil supply and demand. In fact, Canada was producing more oil and gas than ever, but we Canadians were paying vastly more for it. Our research shows that higher oil and gas prices were the biggest single cause of the inflation that caused so much pain across Canada in 2022 and 2023. Thanks to that price spike on futures markets, Canadian households paid almost $200 billion more over the next 3 years. through higher prices, higher interest costs, and then reduced employment income. That's a loss of $12,000 per household. Now, oil prices have come down a lot since then, but we're still setting our prices the same way. What we pay for real oil and gas in Canada is determined by the mood swings of financial gamblers who are playing at a casino on the other side of the world. It's not a question of if another ride on the roller coaster will occur, it's a question of when. And given all the geopolitical conflict, war, and uncertainty in the world today, that next ride is going to happen sooner rather than later. It is not natural or inevitable that the price of one of the most central commodities in our economy should be set this way. The oil industry loves it because when the roller coaster is going up, they make untold profits, close to $200 billion from 2021 through 2024 alone. Consumers pay for it, though, even when those prices bear no relation to the actual cost of producing the oil and gas we use. Now, what can be done about this? Can we get off the roller coaster? Yes, we can. First, it is possible to use financial regulations and circuit breakers to limit how much futures prices fluctuate, and use taxes and regulations to limit how much money is flowing into those paper casinos. It would be better to do that cooperatively with other countries around the world, but Canada can do some of it ourselves. Second, we can buffer the links between futures markets and prices in our domestic market. Limit how much and how fast energy prices can change. Regulate prices on the basis of actual production costs. Most provinces already do that with electricity, and electricity prices did not shoot up in 2022. Third, when the roller coaster shoots up and prices are ridiculously high, we can protect consumers by clawing back the super profits that oil companies make through royalties and taxes, and then offsetting high energy costs with consumer rebates, targeted especially at low-income households. Finally, in the long run, the best way to get off the roller coaster is by accelerating the transition to renewable forms of energy. There's no futures market for sunshine, or wind, or geothermal, or hydropower. Those sources of energy are now cheaper than fossil fuels. They're produced right here, not on the other side of the world. Their prices can be stable, and, of course, they prevent climate change. The common assumption that markets are all about efficiency and supply and demand is often false, and the world oil market is a great example why. Let's get off this roller coaster once and for all. Remember this the next time oil and gas prices spike again. It's not supply and demand at work. It's a system that puts the profits of financial speculators and petroleum corporations ahead of the needs of Canadians for affordable energy and economic stability.